Good evening. If we could go ahead and get started, please. I'm Ben Baker, and on behalf of the Department of Economics, it's my pleasure to welcome you all here tonight. And my welcome extends not just to those of us gathered in Lilly Gallery, but to those watching it on the live stream at davidson.edu/livestream. So to the tens of millions of you watching it that way, I appreciate it. Today has been a great celebration of economics. We started at 4 o'clock with one of the best question and answer sessions we've ever had with Dr. Rosengren and our students at the Carolina Inn. That was followed by a dinner in his honor for a few moments ago that had great conversation and energy in the room. It was amazing. And now we will culminate with the 33rd Annual Cornelson Distinguished Lecture. In a moment, I will introduce Clark Ross, who will come up, who will talk to you about the Cornelson lecture and the history of the Cornelson family with Davidson, and specifically with the economics department. He will then introduce Dr. Vikram Kumar, who will introduce tonight's distinguished lecturer. Before I do that, I just want to say today's been a great day, but none of it happened by accident. A lot of hard work went into making it look this easy, and I want to thank a few people who contributed to that. I know I will forget some, so I apologize in advance, but I will read the ones that I did write down, so I won't forget them too. First of all, Stedman and Sissy Lyles, I would like to thank you for helping us make the contact to get Dr. Rosengren here. We appreciate that. Meg Sawicki, you organized this event with grace and poise, and I appreciate all your hard work. The economic department's on Cheryl Brantz. You're amazing, and we appreciate everything you do. Jay Pfeiffer, our media relations director, you've had a big hand in this, and we appreciate it. President Rosengren's staff, we spoke a few minutes ago about how awesome they've been making all the arrangements and getting the logistics straightened out. Our physical plant workers who made this venue happen, they did the heavy lifting, and we appreciate that. Joanne J. and Alex Smith from College Communications, who are coordinating the live stream. Frank Molinax, who got all this working so we can have it. We appreciate your work. Special thanks to past Chair Vikram Kumar. You kept us on the straight path when we would start to veer away, even though you're on sabbatical, so we thank you for making this work right. Clark Ross, who is our coordinating faculty member of this year's Cornelson Distinguished Lecture. Thank you for getting us all moving. And finally, my colleagues in the department for your support and your input on making this possible. And finally, most importantly probably, to our economics senior majors. This is who the event is really for. And so you've had a long, hard road to get to this point. It's been a steep climb sometimes, but you can almost see the mountaintop from here. So if you would, if you're a senior econ major, please stand up and let's give them a show of our appreciation. Thank you. And now it's my pleasure to introduce Clark Ross, who will continue our preliminary.
Thank you very much. With great pleasure, I reiterate the warm welcome of Chairman Baker to this, our 33rd Annual Cornelson Distinguished Lecture. This is one time when I'm delighted and proud to reveal the actual duration of my relationship with Davidson College. For in the mid-1980s, Charlie Ratliff, Louise Nelson, Peter Hess, and I worked with the gracious Cornelson family to establish this endowment that supports our senior session. The pinnacle of this capstone course for our seniors is the annual Distinguished Lecture. We thank especially George and Ann Cornelson, who with their family, particularly their two Davidson children, George and Woody, made this transforming gift in the early 1980s. We are pleased that Woody, along with her alumnus husband, Shep Robinson, are here this evening. Their son, John, who graduated last May as an economics major, is busy toiling in that industry, highly influenced and partially regulated by today's Cornelson's lecturer. But now, please join me in thanking the Cornelson families. Yes, today marks the 33rd Cornelson Distinguished Lecture. I no longer can devote the time to list all of these individuals, but let me give you a flavor. Juanita Krebs in 1987, formerly of Duke and the Secretary of Commerce in the Carter administration, and a true and loyal friend of Davidson College, gave the inaugural Cornelson lecture, challenging her then unknown Cornelson successors to show Davidson economics senior majors the relevance of their study in economics. In 1989, we had Jack Coleman, former president of Haverford and a true pioneer for social justice, who used a sabbatical to live on the streets of New York to advocate for the homeless. For those whose interests lie in modern macroeconomic theory, that evening in 1995, when Nobel laureate James Tobin spoke, will forever be remembered. We had William Sandy Darity in 2000 from Duke, esteemed as a leading economist with respect to issues of disparity, particularly racial. Greg Mankiw, respected Harvard economist and former chair of the Council of Economic Advisors with President Bush, was here in 2001 to remind us that markets have power and to ignore them risk both inefficiency and inequity. Claudia Golden in 2008, whose work on education and inequality has been a standard in that field, showed us how society, with effort and expenditure, can become more equal and just. I think I can say with pride that this Department of Economics has respected that charge given us by Dr. Juanita Krebs in 1987 to use this distinguished lecture as a means to show our students how important is the work that they have been studying. Let me close by again expressing the profound gratitude of generations of economic students to the Cornelson family, and by calling upon our eminent macroeconomist and former department chair, Dr. Vikram Kumar, who will introduce our own and very distinguished 33rd Cornelson lecturer.
Thank you, Dr. Ross. I like to think that there's a very good correlation between the first Cornelson Distinguished Lecture and my coming to Davidson to teach. So that was my very first year. So yeah, that was nice. Good evening. It is my privilege to introduce our 33rd Cornelson Distinguished Lecturer, Dr. Eric Rosengren, President and Chief Executive Officer of the Federal Reserve Bank of Boston. Dr. Rosengren graduated summa cum laude with highest honors in economics from Colby College. He currently serves as the chair of the Board of Trustees of that wonderful institution. After earning his BA, he went on for a year in Australia as a Watson Fellow, proceeding thereafter to the University of Wisconsin in Madison, where he earned a PhD in economics. He began his career at the Federal Reserve even before he finished his doctoral degree, joining the Boston Fed as an economist in the research department. Rising quickly in the policy firmament of the Federal Reserve, Dr. Rosengren was soon promoted to senior vice president and then head of supervision and regulation in 2000. In 2007, he was named president of the Federal Reserve Bank of Boston, just in time to reinforce the Fed as it faced the worst financial crisis in generations. This was fortuitous because his abiding interest and deep knowledge of the analytical and practical aspects of bank supervision and risk management was then the need of the hour. Indeed, in his work as an economist, Dr. Rosengren has made the link between financial problems and the real economy a focus of his research, and he has published extensively on macroeconomics, international banking, and financial regulation and supervision. Given his high-level multiple responsibilities as president of the Boston Fed, his contributions to the academic literature in economics and finance are extensive. Some 75 articles in journals, including all top journals, some 150 speeches and working papers, many published under the auspices of the National Bureau of Economic Research, and several book chapters. Dr. Rosengren's journal articles include several in that gold standard of journals, the American Economic Review, and in the Journal of Finance, the Quarterly Journal of Economics, the Journal of Monetary Economics, the Journal of Money, Credit, and Banking, the Journal of International Economics, Economic Inquiry, the Journal of Financial Intermediation, and the New England Economic Review. The range of his economic interests is evident in the titles of his speeches and research papers, such as Impact of Greater Bank Disclosure Amidst Banking Crises, Factors Affecting the Japanese Premium, Challenges in Resolving Systemically Important Financial Institutions, Observations on Macroprudential Supervision, and Higher Education and the Economy. As a voting member of the Federal Open Market Committee, the group that decides the direction of monetary policy, Dr. Rosengren's positions and views of the economy are highly sought and widely panned in the media across the country and around the world. No doubt, this is so because of the intellectual gravitas he lends to monetary policy process and to the extensive experience he has accumulated from the front lines of policy. I believe that he's currently the longest serving of all the 12 Federal Reserve Bank presidents right now. Those in the financial industry with deep knowledges of the FOMC, whom I have spoken with recently, remarked that what distinguishes Dr. Rosengren on the Open Market Committee is his deep background in regulation and supervision and his focus on financial stability in addition to the dual mandate of the Fed, of course. They consider him to be a value-adding, thoughtful observer and policy leader who has been very successful in avoiding and anchoring bias in making interest rate decisions by giving due deference to analysis and evolution in data. Dr. Rosengren's training in the liberal arts and his humane instincts have played a self-evident role in his professional life in bridging the distance between Wall Street finance and the Main Street economy. He has led a number of efforts to expand the Boston Fed's outreach and impact on low and moderate income communities, among them hosting foreclosure prevention workshops for New England residents during the Great Recession, and running a competition for post-industrial New England communities to develop cross-sector collaborations to ultimately help improve the lives of lower-income residents in a concrete way. In a foreword that he co-authored with former Fed Chair Dr. Janet Yellen, in a book published by the Federal Reserve Bank of San Francisco called Revisiting the CRA, which is the Community Reinvestment Act, Dr. Rosengren cites various analyses and empirical studies to reaffirm the social importance of this legislation, writing, I quote, "Together with other anti-discrimination, consumer protection, and disclosure laws, the CRA remains today a key element of the regulatory framework," end quote. In these ways, through his professional work, Dr. Rosengren reminds us how to effectively put policy wonky inclinations, training, and responsibilities in the service of uplifting the human condition. Please join me in welcoming our 33rd Cornelson Distinguished Lecturer, Dr. Rosengren, speak on the economic outlook. Welcome.
So I hope I can live up to that introduction. It was very nice, so thank you very much. And a special thanks to Sissy and Stedman, who are in the back row, very close friends who've been wonderful friends over the years, who are alumni from this wonderful school and who encouraged me to actually give this lecture. So a great appreciation for them as well. I actually have ties to Davidson in a somewhat unusual way. My grandfather was a minister in the Southern Presbyterian Church. He was at Riverside Presbyterian Church in Jacksonville, Florida. And one of his roles was to be on the board of trustees of this school. So it's a great challenge to be able to come back to the school that he was on the board of trustees and be able to give this lecture. It's really nice to have that opportunity. So today I'm going to talk about monetary policy, and I'm actually not just going to talk about what's happening right now, but try to give you some context as to some of the concerns we should have going forward over a longer period of time. It's the kind of talk that I would more likely give to an academic audience than a non-academic audience, and so I think it's particularly appropriate, particularly given the number of seniors that are here tonight. So just a quick talk about some of the recent economic events. So the Federal Reserve has a dual mandate, so that's a little bit different than many other central banks, which means we put some weight on trying to make sure we get maximum employment, so that's usually getting the unemployment rate quite low, and we put a lot of emphasis on price stability, which the Federal Reserve has interpreted as being roughly 2% inflation. So those are the two things that we're supposed to focus on. Many other parts of the world, they only have an inflation target, they don't have an employment goal. So that does set us apart from many other central banks. Our economy's actually been doing quite good by that criteria. So if you look at core inflation, which is taking out oil prices and food prices, and ask what is the underlying inflation rate, it's 1.8%. So our goal is 2%. For an economist, being only 0.2 off, not too bad. In terms of labor markets are quite tight. This is a great year to be a senior going out into the job market. 3.8% unemployment is very low by historical standards. Is this a little too high up? Okay. So 3.8% is a very tight labor market. So it's wonderful that our economy is doing as well as it has. Last year, the economy grew about 3%. This year, most forecasts think we're going to grow much closer to 2%. So it is slowing down relative to last year. But one of the reasons it's slowing down is because we're so close to full employment. So if you're not being able to hire more labor, it's going to limit how fast you can actually grow. In terms of inflation, one of the things I'm going to talk about is even though we're only missing by a little bit, it actually does matter if you miss by a little bit on a regular basis. And in fact, if you look over the last decade, we've been a little bit below our target actually quite frequently. And we're not alone. Japan and Europe have been undershooting their inflation target by much more than the United States. So it's a problem in much of the developed world that central banks are having trouble hitting their inflation target. When you take your introductory economics class, inflation is the one thing the Fed's supposed to be able to control pretty well. So it's a little bit of a problem if we're having so much trouble hitting that inflation target. So one of the reasons why we have our current monetary policy, where if you've seen the last couple of statements coming from when we announce what we're doing, we've announced that we're going to be patient. Well, one reason to be patient is that there's been a slowdown internationally, so we're somewhat concerned that while we think it's going to grow 2%, there's some risk that it could grow slower, and we don't want to grow that much slower, so that certainly is one concern. But the other concern is we've been missing on inflation by a little bit for quite some time, and given that we do have a 2% inflation target, I'm going to explain why it actually makes a difference over time if you keep missing on your inflation target. So why is undershooting inflation a problem? Well, the leading example is probably Japan. So Japan is a country that decades ago started missing on their inflation target. They had actually a financial crisis much earlier than we did. And they had a fairly long period where they were having a tough time even getting positive price increases. In fact, I've talked to people at the Bank of Japan who have never had a salary increase. Just think about that. So they've had zero inflation rate for a long time. It's been negative for part of that time. And they have a 2% inflation goal. Well, if your central bank says our goal is 2%, but year in and year out it's zero, eventually you stop having any confidence that the central bank is going to be successful at hitting their 2% inflation target. So you act like it's going to stay at zero. And so Japan, even though they've announced a 2% inflation target, have found it really, really hard to actually get inflation up. That's because it's really important to get inflation expectations right. So if you don't get inflation expectations and people don't believe you can hit 2%, it actually becomes quite hard for the central bank to do that, even though that is one of the main goals. Every single central bank in the world has an inflation goal. So the second thing is, why should we care in general? And this is going to get at really the topic that I'm really focused on, which is having enough room to react on monetary policy. So the rate that we normally use to affect the economy is called the federal funds rate. It's an overnight rate, and right now it's roughly 2.4%. So let's think about what 2.4%. In a common recession, we lower rates by 5 or 6%. So if we're at 2.4 and you can't have really negative interest rates, it means you're going to hit 0. And in fact, in a garden variety recession, we're likely to hit 0, which means then we have to use our balance sheet or some other tool if we want to continue to stimulate the economy. So I'm going to talk a little bit about what the implications are of a fairly low inflation rate, a very low interest rate environment, and what that means next time we have a recession. Now let me just emphasize, I'm not expecting a recession anytime soon, so this is not a forecast of a recession. This is just saying that we want to be prepared that whenever that negative shock occurs that's important enough that it slows down our economy, that we're actually prepared to think about how to address that. So having adequate monetary space is really important because we need to have that flexibility to move interest rates. So part of that is through the short-term interest rate, and it becomes really important that we anchor expectations high enough, and I'm going to explain a little bit further slides, that if you keep missing on your inflation target, inflation expectations are lower, and it actually results in a lower interest rate, less room between 0 and where you're setting the interest rate. So I'm going to talk about getting enough room for that and talk a little bit about how the Federal Reserve can do a better job of reinforcing its 2% inflation target. In fact, this year we're doing something that we've never done before, which is we're rethinking our entire monetary policy framework. And the purpose of rethinking that monetary policy framework, it's something that Bank of Canada has done every 5 years, which is say, well, if we keep missing on inflation, what can we do to make sure we actually hit 2%? Or some central banks have thought about how important is financial stability for how we set interest rates. So the Bank of Canada, every 5 years, goes through a process of thinking about, should we change our goals? Should we do anything differently? The Federal Reserve has never done that. And so this year we're actually doing it. We're actually holding meetings around the country to talk about our current framework. And I'm actually on the communications committee that's responsible for organizing all these meetings across the country. In June, we're having a meeting in Chicago that's bringing in top economists from all over the country to give us advice on what we should be doing. And we're going to take all this information, put it together, and ask, should we change the way we do monetary policy? So this is a little bit about talking about whether we have the right framework to actually meet our 2 goals. So it's not changing what Congress has told us to do. Congress has told us maximum employment and stable prices. But the way we've implemented, we haven't hit it perfectly, and I'm going to talk and show you some data that reflects that. So this shows you the overnight rate in 3 places: the United States, which is the dark blue, Japan, which is green, and the Euro area, which is blue. So you can see in previous periods, there was a recession in 2000, there was a recession in 2008. You can see that rates were much higher. And a typical reaction whenever we have a recession is to lower short-term interest rates. So as long as interest rates are high enough, that's not a problem. But you can see, let's use the example of Japan, the green line, they're already slightly negative. So if they were to have a recession now, they can't lower short-term interest rates. They're about as low as they can get. If you look at the Euro area, they're actually negative as well too. So if a recession were to hit right now, they can't use short-term interest rates to really address that problem. Now you see, we're in a little bit better position. Our economy, we actually stimulated the economy a little bit earlier into the crisis, which means our unemployment rate is lower, our inflation rate is a little bit higher. And as a result, that stairs of interest rate increases has gotten us up to 2.4%. But if you look at 2.4 and compare it to the previous periods, you can see we're nowhere near as high as we were when we came into the last 2 recessions. So it's not just a problem for the United States, and actually it's a bigger problem for other developed countries than it is for the United States. So just to reflect a little bit, this actually shows the recession shading. So the little red dots are showing you the peak interest rate and the lowest interest rate, and the shading is showing you where recessions occurred. So not surprising, in a recession, we lower rates to try to stimulate the economy, because in a recession, the unemployment rate gets quite high, so we're missing on our unemployment objective. And the inflation rate tends to miss our 2% target, So we're missing on that target. So the way we stimulate the economy is to lower rates, and you can see that we really do substantially lower rates. The chart on the right just gives you an idea that it's between 5 and 6% that we normally have reduced rates, and you can see the current rate. So it's just another way of describing the problem, which is we don't have very much room if the main way that we want to affect the economy is through short-term rates. So that is definitely a problem. Now, there's another way that we can try to impact the economy, and it's the way that we impacted the economy during the financial crisis. So during the financial crisis, interest rates got to zero, the short-term interest rates, but that didn't mean we stopped doing anything. We didn't close down the Federal Reserve and go home until the economy did better. We actually tried to stimulate the economy in a different way, a way that we had never done before, which is to purchase a lot of assets. The assets that we purchased were long-term Treasury securities and long-term mortgage-backed securities. The Federal Reserve is only allowed to have securities that don't have default risk, so that means mortgage-backed securities with government guarantees and Treasury securities. And so what we're trying to do is we couldn't do anything to the short end. We're trying to flatten the yield curve. The long-term rates were pushing down. How are we doing that? We're buying lots of those assets. By buying the assets, we push down the long-term interest rate. That means if you want a car loan, if you want a loan on a house, it's going to be cheaper. And we're trying to get the economy to revive itself by stimulating those parts of the economy that are interest sensitive. So this shows you how much central bank assets increased relative to GDP. So relative to the size of those economies, how much did the central bank expand their balance sheet? Now, prior to the financial crisis, I never once talked about the balance sheet. And the reason is, if you look at the blue line, which is the United States, and just look from 2004 to 2008, it's not very interesting. It's a flat line. So nobody worried about the balance sheet during that period because the main way we affected the economy was short-term interest rates. We didn't use our balance sheet. But starting during the financial crisis, and we started buying these long-term assets, so we started focusing on the long end of the market, and as a result, we substantially increased the amount of our balance sheet. We went from under $1 trillion to $4.5 trillion at its peak. So a very big increase. Now GDP was growing during this period as well. So this is scaled by the size of the economy. But the two other areas that I'm showing, you can see in Japan, in order to try to get their inflation rate up, they've been buying lots and lots of assets. And they've been buying a lot of assets we couldn't buy in the United States. We can't buy a lot of the securities. They've been buying private securities. They've been buying stocks. So they've been holding a large group of assets in the United States we'd be prohibited from doing. In Europe, you can see that they started a little bit later than us in expanding their balance sheet, but they've had to continue to grow it much more over time. So both Europe and Japan, relative to the United States, have had to buy a lot more assets. And you can see that this line has trended down. So we started slowing down how many assets, and we're now at the point where we're not growing our balance sheet and GDP is growing. So you can see that this has trended down a little bit. So in the United States, not only have we got a little more room on short-term interest rates, we also have a little bit more room on long-term interest rates. And this just shows you the 10-year rate. Now let's, again, take a quick look at Japan, the green line. Their 10-year rate is basically at zero. Well, that means they can't stimulate their economy by lowering short-term rates, but they also can't really do a whole lot to stimulate their economy by pushing down long-term rates. So they have a real problem in terms of if they go into a recession now, it's going to be very hard to focus on monetary policy to do that. Europe's not much better, so I used Germany because they have the lowest default risk of any of the European countries in the euro area. And you can see that they're basically at 0 too. So that you can't buy a lot of 10-year Treasury securities in Europe, at least German securities, because it's already quite low. So they don't have much policy room at all. Now, there's fiscal policy. There are other things a government can do. But it means that monetary policy is going to have a much more difficult time in those parts of the world addressing the next recession. You can see we have a little bit more room, roughly 2.5% on a 10-year rate. So we both have a little bit more room at the short end, and we have a bit more room at the long end. So we're in a better place, but not exactly where we want to be. So the topic of the talk today is limited policy space, and I've just given you an example of what that limited policy space is. If short-term interest rates are near zero, which they are in Japan and Europe, and to a lesser degree in the United States, we have a little bit of space, but not as much space as historically we would have going into a recession. If you look at the long-term government yields, in many parts of the world, they have no space either, but we have a bit of space. So one of the challenges for monetary policy, one of the biggest challenges for monetary policy at this time, is to think, how do we get enough monetary policy space that we can react whenever there's a recession? So I'm not expecting a recession anytime soon, but I do think we should be prepared for one. Recessions tend not to be predicted very well. The private sector doesn't do a very good job of predicting recessions, neither does the central bank. So they tend to be unanticipated events that cause a recession. So we should always be in a position where we're comfortable that whenever that recession occurs, we have the ability to respond. So this is a little wonky slide, so this is the wonky part of me. So our interest rates are 2.4%, and I'm just splitting it in two ways. One is the core inflation rate. So you think about if you're getting a return on an asset, you want to be compensated for the inflation rate. So roughly, inflation expectations now are 2%. I said 1.8. Let's assume it's right at 2%. And then there's the real interest rate. What determines the real interest rate? Well, lots of things determine the real interest rate in the short run, including the Federal Reserve. But in the longer run, it's more broad things that are occurring in the economy. So how productive is labor is one of the things that affects it. How fast is the population growth occurring? Well, if you think right now, population's not growing very fast in most parts of the world. So that means that the real interest rate might be a little bit lower than it normally is. Inflation's been pretty low, so inflation expectations are low. So that means another reason why interest rates are going to be low. And productivity hasn't been that good. The productivity for the US economy has been roughly around 1. It's been a little bit better recently, but let's say 1%. So that means that the real interest rate, both in the United States and the rest of the world, is pretty low. Now, when you think about this inflation expectations, if I think inflation is going to be 1.5% instead of 2%, well, now I only need 1.5% to compensate me for inflation. I still have that light blue for real interest rates, but it means now there's going to be even less room before I hit zero in a recession. So one way to be sure that we have a little bit more policy room, the one that we can most affect, is to change those inflation expectations, make sure they're really at 2%. So this is what our actual experience has been for inflation. So this is looking at the core. So our actual inflation target is with total, but the numbers get affected by oil price shocks that both up and down. So I've just used core inflation as a proxy for the total. The green line is our 2% target. And what you immediately see here is we've missed a lot. So there are a couple times that it's a little bit over that green line. For the most part, it's been below that green line, which means if you think that if you were going to say we can't have inflation higher than 2%, so if you thought inflation was a ceiling of 2%, it would kind of look like this. If instead you said we're going to have a symmetric goal for inflation, you should expect about half the observations above and half the observations below. And in fact, what we say in our policy statement is that we do think it should be symmetric, that we want it to be basically equally above and below, but we haven't quite done that. So that is one of the challenges, is how do we make sure that we continue to have 2% inflation firmly ingrained? This shows it to you the same way. So a symmetric distribution would mean the right part of this graph looks the same as the left part of this graph. So it's showing you the number of quarters. For example, this first column is under 1.1%. So there are 9 observations over this period where it was under 1.1%. And so each of these are a range for inflation. So we haven't had very many periods when it was over 2.9%, and we haven't had that many periods on that right-hand side, which is basically saying the same thing as that last chart. If this was symmetric, they'd look kind of the same, more like a bell-shaped curve. That's not what we're seeing, which is another way of saying that we don't seem to be well balanced around our inflation target. So, do we have a symmetric 2% goal? The Federal Reserve has said our 2% goal is symmetric. But when we actually look at the data, the observations say that we haven't actually implemented monetary policy in a way that's fully consistent with that. So one of the reasons why we're holding rates right now is because of concern that once again, we're a little bit below that 2% inflation target. And we haven't been very good at getting that symmetric inflation target, even though that's what we've announced publicly. So one of the questions is, should we alter our monetary policy framework to a better job of trying to make sure that we hit 2% inflation? We've said it's symmetric, but how could we reinforce that? And that's really a discussion about whether our framework should change. Should we do something about our framework to make sure that we're more consistent hitting our inflation target, which would mean that we're a little more comfortable being above as well as below? So one way to think of this is that during the good periods, you're going to have inflation a little bit above. During recessions, you're going to be a little bit below. And so in order to average 2, you have to accept roughly as many observations above as below. Now, these troughs are a particular problem because how do we stimulate the economy? Well, we do it by lowering interest rates, both short-term and long-term interest rates. Well, if we know that we're hitting the zero bound for short-term and long-term interest rates, it's going to be really hard not to have inflation slip more during the down times. So it means we need to push rates up a little bit more during the good times. So one way to think about this is rather than a 2% inflation target, one way to address it would be to say that we have a range. During periods where we think we're going to have trouble with monetary policy because interest rates are so low, we know we're going to be below 2%. So during those periods where we're doing better, we should actually be shooting a little bit higher and be more comfortable being above 2%. Somewhere between 2 and 2.5%. So one option would be to think about this more in terms of an inflation range. We can't hit the inflation target perfectly, and so one way to do that is to try to have this range. There's a second way to do it. It's called inflation averaging. So this is just taking the average over different periods. A 5-year average, and this is the dark blue is the total inflation rate, and the light blue is the core inflation rate. So we have 5, 10, 15, and 20. Well, no matter how you average looking backwards, we haven't done a great job of hitting 2%. So if you really had an inflation average, and particularly if you were including history instead of the future, you'd want to be sure that you had an average during periods when you had a low average. You're going to have to allow some periods over 2% to make sure it averages out to 2%. So there are a bunch of people that have suggested that maybe we should have a 2% inflation average. Now, there are lots of ways to calculate average. I've shown you one way to do it, 5, 10, 15, 20 years. But it's also, do you include forecast periods? Do you only look backwards? Do you look forwards? There's lots of things to think about that, and the details actually matter in these cases. But this would be another way to reinforce the idea that if we had an average over some fixed period, maybe we do a better job of hitting our inflation target. A third option, which is a little wonkier, is price level targeting. Price level targeting is saying, I have a price that I pick at a certain time, and I just arbitrarily picked it as January of 1999, and I'm just going to draw a line with a slope of 2%. And I'm going to want to make sure that I stay on that green line. Now you can see that that blue line is under that green line at all times. So if you're price level targeting, if you're low one period, you have to make up for it some other period by having it above that green line in order to get it to average out. So this is a way of kind of, if I make a mistake in one direction, I have to offset it in another direction going forward. This is a little bit harder to explain. Price level targeting, hopefully most of you understand what I'm saying, but I'm not sure if I was talking to the general population and I said I want 2% price level targeting and I showed that line. How great a communication device would that be? Not so sure. My guess is it might be a bit of a challenge. So those are three possibilities of just examples of how we could change the framework to try to reinforce that 2%. So the range, 1.5% to 2.5%, relatively easy to understand. It admits that the Fed can't hit the inflation target perfectly. And it's probably reflecting the fact that during recessions and we're hitting the zero lower bound, we're going to have to hit for a higher amount during the good times if we wanted to average 2%. The inflation average, details matter, But the bottom line is that during a period where we've undershot for quite some time, we'd have to overshoot in other periods. Price level targeting says anytime I make a mistake on one side, I offset it the next time. My own preference would be an inflation range, but this is what we're arguing about over the course of this year. This is what we're going to get feedback from the public, from academics, from a variety of different organizations to get a better understanding of how can we reinforce that 2%, not just because we're worried about the inflation rate, but because we want to have enough policy room that whenever that next recession hits, we don't want inflation expectations to be low. Now, I did talk a little bit about the asset side and the balance sheet. So it's not just interest rates that can give us a little policy room, and I just have one slide on this, but what this is showing is the assets the Federal Reserve holds. And so you can see the Treasury bills, other Treasury securities, green is mortgage-backed securities, and then other assets. And if you look back to January 2004, we didn't have any mortgage-backed securities at all, but we did hold a lot of Treasury bills. Now look at where we are right now. We hold no Treasury bills, and we have a lot of Treasury securities and mortgage-backed securities. So in effect, we're holding the long end of the Treasury market and long rates for mortgages down by having this kind of a portfolio. One way you could get a little bit more policy space is to have something that looks a little bit more like what we had prior to the crisis. Hold more short-term securities, fewer long-term securities. That should raise the yield curve. And if we have a bad recession, one of the things you can do is swap the short securities for the long securities and flatten the yield curve. Now, if I don't have any short securities, there's nothing to swap, so it's very hard to do it. I have to then buy new assets to expand my balance sheet. So there are other ways to get policy space, and I'm not going to go into all the details of how you can do it, but that's just an example of it's not just on interest rates that we could get more policy space. So concluding observations, a low interest rate environment poses a real challenge for monetary policy. The way monetary policy works is we try to change the cost of credit. And so if interest rates are very low, which they are in many parts of the developed world, that provides limited policy space for us to be able to react when the recession occurs. This is a great time for us to be analyzing that framework because we want to be sure that we take whatever actions we need to bolster that policy space now so that whenever that recession hits, we're better prepared. And it's even a bigger problem if you look around the world. This is a real problem if you think about both Europe and Japan, which just means if a recession would occur right away, globally, it would be a problem, and that's one reason why people have been so concerned about a global slowdown, is because in many parts of the world, they don't have many ways to react in an aggressive way or as aggressive way as they normally can. So, long way of saying we need more policy space. So I'll stop there. It was kind of a wonky talk, but hopefully you got most of it, and I'd be glad to answer any questions that people have.
If you have a question, if you'd please come to the microphone so everyone can hear your question. There's a microphone over there, one over here, and we appreciate you queuing up.
Looks like the right side's better than the left side.
If Japan is having trouble meeting inflation goals, why don't they just print more money?
So when we expand our balance sheet, for example, we are printing more money. But printing more money alone, Japan is an example where an awful lot of money has been printed, but if their expectations are very low, it's hard to actually change expectations just by printing money. So printing money is one way to try to improve the inflation rate, but it doesn't happen magically. People have to be convinced that you're going to stimulate the economy enough and allow inflation to actually pick up. There were a number of things that occurred in Japan. One is they tend to tighten every time inflation started to pick up, even though they had a higher inflation goal. And they've tended to restrict their fiscal policy when they've started to have their economy pick up. So people haven't been completely convinced, even though they've expanded their balance sheet very substantially, that they're going to get a higher inflation rate.
Thank you.
Thank you for the question.
Hello, my name is Graham Bullock. I'm a professor here in political science. And my question is sort of a follow-up, I guess. So can you comment on the relationship between fiscal policy and monetary policy and this concept of a policy space?
Yep.
And more specifically, the implications of sort of this new, relatively new idea, modern monetary policy, and the idea that, you know, debt and deficits maybe not matter as much generally, and then specifically this idea of using the Fed's balance sheet to fund social programs. Thanks.
So I think that was more than one question. But let me talk, actually that same question came up with the students this afternoon. We had a very nice interactive discussion during the afternoon, and a number of these issues actually came up during the course of the Q&A with the students. So thinking about the United States, we're in a somewhat different position than many other countries, and the reason for that is we're a reserve currency. So when you're a reserve currency, it means lots of transactions around the world are conducted in dollars. So if you go to Panama, their currency is dollars. If you go to Cambodia, their currency is dollars. Lots of parts of the world use dollars, which means we have a little bit more flexibility than many other countries. So if you look at, for example, Italy, which is not doing so well in Europe, when they have problems fiscally and when they're running a bigger deficit, you see that their interest rate goes up very substantially, which actually makes it start squeezing out the rest of the federal budget. So I think it does depend. I think we have more flexibility than other countries, but I think all countries can't expand their balance sheet and run deficits forever faster than the economy is growing without suffering implications because people start losing confidence and start worrying about sovereign risk. And a good example is what's happening in Italy relative to Germany. German rates have gone down, Italian rates have gone up as people have been concerned about the fiscal situation. The way I think about fiscal and monetary policy in some countries that are parliamentary, it's a very different system than the United States that's built on checks and balances. So in the United States, we basically take fiscal policy as given. So Congress and the president go first and determine the fiscal policy. And then we set monetary policy to try to get inflation and unemployment right for what Congress told us. So think of it as a repeat game in which Congress and the president always go first and we always go last. So we try to get the right answer. So if we have really, really stimulative fiscal policy, then we're probably going to have tighter monetary policy. And if the exact opposite, if fiscal policy is really tight and we're worried we're not going to hit our inflation and unemployment goal, then monetary policy is going to be easier. So it's not so much coordinated as the Federal Reserve has a congressional mandate to hit its goals. And we hit those goals conditional on whatever fiscal policy is going to be. So we take it into account, but it's not a coordination. So a good example during the crisis, we actually, when you get interest rates that are very low, fiscal policy is much more effective because you can buy lots of things and you're not going to have much of an effect on interest rates. And so normally you would expect in a bad recession, you'd probably rather use more fiscal policy and a little bit less monetary policy. But if Congress and the president decide not to use that fiscal policy, that's going to force us to do more monetary policy. And in fact, during the crisis, that's exactly what happened. They started with a very stimulative fiscal policy for a variety of reasons. They pulled back on that, which probably meant that we had to do a little bit more on monetary policy than we otherwise would have chosen to do. So it's not a coordinated, it's a kind of a sequential game. But we certainly take it into account. And we don't really comment a whole lot on fiscal policy, and we hope that fiscal policy doesn't comment a whole lot on monetary policy. Sometimes that works, sometimes that doesn't. But in general, we view it as independent decisions.
Yes, thank you. For the last 39 years or so, since about 1980, interest rates hit a zenith, Fed funds rate and other interest rates in 1980. But as I looked at there's a chart, the 62-year Fed funds chart rate, since that time, every recession that's occurred in our country has been initiated or triggered at lower and lower rates, recession after recession, repeatedly. Every recession begins at a lower Fed funds rate. Can you help me understand why that's occurring? Is it the aging of the population? Is it the taking on of more debt by all of our society? Something's causing these recessions to initiate at lower and lower rates, and I've always been perplexed on why that occurs. Thank you.
Okay, so just a little history. So if you go back to 1979, our problem wasn't that inflation was too low, it was that inflation was too high. And Paul Volcker came on and raised interest rates to a very high level. And inflation during the 70s had gotten close, not quite to double digits, but quite high. And so he took very stringent actions to try to bring the inflation rate down. So if your inflation expectations are really high, your interest rates are going to be very high too. So from 1979 on, the Federal Reserve has been trying to get the inflation rate down. So one component of interest rates is how much I compensate people for inflation. And so we now have this 2% inflation goal. Arguably in the 1970s, we didn't have a 2% inflation goal. So that inflation goal has gone down, and not only in the United States, but around the world. So if I have a 5% inflation, I'm going to have much higher interest rates than if I have a 2% inflation. So one of it is an intentional reduction in the inflation rate in most developed countries and trying to hit a lower inflation rate than what we had before. So that was one of the reasons. But the second reason is actually much closer to what you were talking about. So the countries that are having the most problems with having a higher interest rates are also some of the countries with the biggest demographic changes over the last 10 or 15 years. So if the population's growing very slowly, or if the economy's not all that productive, then that real interest rate component's going to be quite low. So one reason that it's gone down is inflation, but another reason that it's gone down is some of those other factors that are important for the real interest rate, things like demographics, things like productivity, have also been going down at the same time. So all these things have gone down at the same time, resulting in the interest rate that you see at the federal funds rate or in many other countries at the short end of the market are much lower. So some of that is by intent. Now, nobody wants a low productivity economy. That's not the intent, but monetary policy can't really do that. Lots of things affect productivity over time. It's kind of a slow-moving process. It's how quickly do new technologies get introduced into the economy and become widespread. So the leading examples that people use is when we started having electricity, all kinds of new devices and other things started happening that made the economy much more productive. People could argue about the internet did the same thing. But right now, we're actually in a period where, for the last few years, productivity's been pretty low. Now, it's been a little bit higher over the last couple of quarters, but it's a slow enough moving process, it's really too soon to say whether that's actually going to happen. So it's kind of a combination of factors, but those are the main reasons.
Thank you so much.
Yep.
Thank you for
The other side of the room gets an opportunity.
Yeah. So the question is, you've got interest rates so low for so long. So there's a chart out there which is GDP to U.S. household net worth. And they put it out there. There's been 3 bubbles since 2000. The first was the tech wreck. The second was the financial crisis. Each time when it fell, you slammed rates down. This time, you've left rates low. And Buffett would say interest rates act like gravity on the value of all assets. What this is implying is that U.S. household net worth should not be growing faster than GDP, and they call this bubble the central banker's bubble, that the central bank is actually responsible for the bubble, and it's got to be deflated somehow. And then the Fed would try to increase interest rates in December. I've heard some people say it was a mistake by the Fed to do what they did, and now some would say maybe pandering, which I know that's not the case, but to Trump, who's saying stop it, and now Trump is out there trying to say I'm going to pick a new Federal Reserve chairman, which is ridiculous, right? That can't happen. But it's this idea of, is it prudent to have left interest rates this low? And then I know what you're saying is that you're trying to hit the inflation target, so you've stepped it up, but now you've stopped. But interest rates are so low that the value of all assets are extremely elevated. Market cap to GDP, which is one of Buffett's favorite indicators, is showing extremely overvalued. So just what are your thoughts on how prudent it is to maintain rates? And I'm sorry, Greenspan said for a period of time, right, you let the proverbial punch bowl out for too long. It seems like it's not only been left out, but maybe it's been triple spiked. with where asset levels are. How are you going to get interest rates? So how do you answer it? How do you get the interest rates back to where you're comfortable that you have the monetary tools? You know, Japan, Germany are in worse position than us, but the United States, so that if we do have that next economic downturn, what are you going to do? You've got an elevated balance sheet, you've got low interest rates, you've got other tools, but these are your biggest tools. But, you know, what's the risk?
So this question is very much related to the question that I just got. So anybody who's had accounting or finance, present discounted value is one of the ways to figure out what the value of an asset is. And so the denominator has an interest rate. If the interest rate's going to be lower, then you're going to actually have a higher multiple. And so one consequence of interest rates over the last 3 decades gradually coming down has been also that you would expect that if you're just using a present discounted value formula, it's going to imply that asset values are going to be higher because there's a lower interest rate as a competition for that asset. So that doesn't necessarily mean that the asset is mispriced. It does say that I'm discounting by a lower interest rate than I was before. Now, when the Fed's setting monetary policy, we don't have that. Our goal is stable prices and full employment. It's not the stock market or the bond market. It's not valuation. There are other things that we can do for valuation. For example, bank supervision worries about that. And I actually think that we should think a little bit about financial stability issues. If you look at the PE ratio, it's a little rich. I wouldn't characterize it as a lot rich relative to history. Now, there are lots of ways to calculate a PE ratio, but particularly when you're taking into account where the interest rate is, I don't find that we're way out in the extreme. So if I took quarterly observations of PE ratios, I'd be to the right of the median, but far from the tail. So it's a little rich. I wouldn't characterize it as a lot rich. And so I'm not going to take a really significant action to slow down the economy when I'm not even hitting my inflation target just because we're a little bit rich. Now, there are some assets that I worry about. So the household sector is in a much better position than it was going into the last crisis. But I would say that corporate debt is a little bit on the high side relative to what I'd like to see. Setting interest rates alone is not a great way to try to micromanage, for example, corporate debt. There are probably other tools that are better to do that. But that is certainly something to worry about. So I worry about financial stability concerns. I wouldn't say that my financial stability concerns are so large that I would want to slow down the economy from where we are. We're already talking about growth of 2%. We're talking about an unemployment rate that's pretty tight, but we're missing on our inflation target. So if we want to hit our inflation target, that gives us a little more flexibility to keep rates lower than normally. So if you look back at those previous recessions, one of the causes of the recessions was we started worrying that inflation was getting too high, and we tightened rates more with the purpose of slowing down the economy. Now, unfortunately, we're not perfect. It's not like changing the thermostat on your furnace. We can't just get it from 72 to 73. Sometimes we go 72 to 73 and we get 76, and the economy slows down more than we anticipated. So we're not fighting inflation right now. In fact, as my slides highlighted, we have the opposite problem, which is why we've been more comfortable having interest rates low. But I do think that we have to continue to watch what's happening with financial stability issues. So, I mean, I think that's a good question and something that the Fed has to wrestle with. But given what our mandate is, it's appropriate for interest rates to be paused right now.
Maybe we can take these last 2 questions because Dr. Rosengren's had a long day. So.
My question is pertaining to one of the graphs that you showed that had Japan experiencing negative interest rates over the past few periods. In periods of negative interest rates, what incentive do lenders have to lend? And in the same vein, what incentives do consumers have to make deposits if there's going to be little to no return on investment?
So the way negative interest rates, it's very institutional how negative interest rates are actually applied in most countries. So for the most part, one reason interest rates can't get too negative is because I can always hold currency. So think what's in your wallet. You got dollars, it pays a 0 interest rate. During most times, that's not a great return. If all the other assets are paying a negative return, it's actually a very good return. So one reason why no central bank has tried to push their interest rates really negative is because they're worried that people will just start holding currency. So if you get too extreme, everybody will start holding lots of cash rather than short-term assets, and it starts becoming inefficient. There's another problem with negative interest rates, and that's tied to financial institutions. So most financial institutions borrow short and lend long. Negative interest rates make it really hard to make money with that model. So if you're worried about banks being profitable and being able to make credit available, negative interest rates are actually, in my view, not a particularly effective way to stimulate an economy. Europe and Japan have experimented with it. I'd say the results are pretty mixed to date. So if we were to go into another bad recession, my own personal view, this is just my view, is that the United States shouldn't use negative interest rates as a policy tool. I think we have other policy tools that are more effective. So last question.
So this is going to be something from the blogosphere from a few years ago, but there used to be a lot of talk about nominal GDP targeting as an alternative to inflation targeting. Now I know that it's part of the Fed mandate, but is it something that economists are taking seriously at the Fed as well, or is it just talk in the blogosphere?
So nominal GDP targeting is a lot like my price level targeting, but it's tied to nominal GDP. And one of the problems is it's not completely consistent with our mandate. So as we're doing this exercise for our framework, we've set out that we're not going to do anything that would require a legislative change. So we're taking the framework that Congress has given us as given and say what's the best way, given that congressional mandate, how do we best solve for that? Arguably, nominal GDP targeting is harder to fit into that framework. I actually think it has one of the same problems that price level targeting has, which is for a general population. It's hard to even explain what nominal GDP is. Nominal GDP targeting is taking it one more step. That makes it hard to explain. Central banks are already confusing and hard enough to understand, so I think it's kind of hard to communicate more generally. But that's a matter of opinion. A lot of economists think nominal GDP targeting is a better way to go. Most of the numbers that they use for what they want for nominal GDP targeting imply a much higher inflation target. So if we want to continue to have stable prices, that much higher inflation target may not be consistent with what Congress thinks stable prices are. Okay, well, thank you very much for your questions and appreciate it.
I want to thank you all. I want to thank you all for coming. I hope you have a great evening, and I want to thank Dr. Rosengren for making the economics department look really good today. Thank you.
A song I'm told